Let me also welcome in Nilesh Shah, who's joining us. Nilesh, good to have you with us. Now we're entering, a phase where, of course, we're starting to see Q1 numbers, but the markets seem to be driven purely on hope at this point of time. Nilesh, reading more into commentary on the recovery, we were just listening to the SBI chairman as well, saying that it's sharper than expected. What's your sense, while we continue to see some parts of the country go back into lockdown, on the other hand, we are starting to hear some positive commentary coming in on the pace of the recovery?
Yeah, so I think really this has essentially been a market all about recovery, revival, resurgence, rebooting. And of course, what's really helping us essentially has been very, very strong global liquidity and a very strong participation from retail investors. But clearly, I think, and I think also the market is shrugging off the initial results which have poured in of Q1. And at this stage, obviously, the market is probably thinking this to be exceptional items in a way that when you have a company which goes through an adversity and it basically kind of marks something as exceptional, the market after a point of time tends to basically kind of overlook it or move on. And what it looks like, I think, is that, yes, while the Q1 results are not so good, the start is not so good, but they were expected to be not so good. And clearly the market is now wanting to kind of look beyond the Q1 or the H1 of this financial year and see how essentially you're going to have a recovery in H2. And the expectations are that the H2 will essentially be with a big bang. So clearly, I think the markets at this stage are more focused on H2 of this financial year and maybe even the next financial year, which is the financial year FY22. I think we have to also keep in mind that what caused that huge fall in March was essentially around the virus and more around the lockdown. Clearly now I think there seems to be a consensus that yes, of course, the virus is going to stay with us for some time. But maybe sometime a few months later, there is going to be some kind of a remedy which is going to come in. And there is not going to be a nationwide lockdown. There are going to be pockets of lockdown, and maybe they are not going to be lockdowns which are going to extend into months, but maybe lockdown which probably will last for a few days or a few weeks, and that too in some pockets. So I think on the whole, what it looks like is that both from an economy point of view, as well as from a markets point of view, maybe the worst is behind us. And I think really the markets are more focused on how things will unfold over the next maybe 4 to 6 quarters.
Sure. So, looking at it from a slightly longer term point of view, Nilesh, on the financials, since that seems to be front and center, of course, in terms of the focal point, we've seen this huge rush towards fundraising, quite a substantial amount to perhaps address any potential bad loans and an increase in provisions. We have heard the RBI governor also talking about how banks are well positioned, although vulnerabilities remain. What's the extent of the risk that you see there?
There are two parts to this. Essentially, is there a risk, and when will this risk essentially come to the fore? So yes, I think there is a risk in terms of the credit portfolios, be it banks or NBFCs or any other segment. And clearly, I think various rating agencies as well as the Reserve Bank of India have already indicated that there is going to be stress on asset quality and NPAs are going to spike up. However, all this is likely to come to the fore probably towards the end of this calendar year or the start of the next calendar year. This is essentially when it's actually going to kind of come to the fore. So in between, there is going to be this period where essentially the asset quality is going to look fine. And some of the well-managed private banks essentially are going to come in with great numbers as well. We've seen some of the private banks already come out and share their quarterly updates for the March quarter. So I probably think that maybe the banking space is going to be fine for a few more months or maybe even for a couple of quarters. And it's only when we see the actual NPAs or the stress on asset quality come, which is again towards the end of this year or maybe start of next calendar year, that is probably when you might see some correction, especially if there are negative surprises. But otherwise, the narrative is already building up. And I think within overall financials, I think one has to look beyond just the well-run private banks and look out for some of the other plays in financial, be it general insurance, life insurance.
Nilesh, where are you looking at migrating flows? Are you looking at buying beaten down very PSU names or construction companies where the margin of safety is now the highest because they've been beaten down black and blue? Or are you still following an approach of buy good companies with a 2-3 year time frame? You cannot play on valuations, but if you play terminal, which is time, some of these stocks will give rewards.
Yes, so we continue to be focused on buying good companies with a 2 to 3 year horizon. That continues to essentially be the core of our investment philosophy and our strategy. So that's what we are kind of focused on. And what we believe that there are going to be pockets which will do well over the next 2 to 3 quarters. Yes, the next 2-3 quarters are going to be stressed for most companies and for most businesses. But clearly from a 2 to 3 year perspective, there are going to be several industries and several companies which are going to basically get back their growth mojo and will essentially do well and are available at valuations which are way more reasonable than what they have been in the past. So that continues to be our strategy. One area that we are beginning to like quite substantially is essentially the fallout of the rural economy, in the sense that, yes, the rural economy is likely to do well. Outlook on farm output is great. And we think that a lot of that surplus will start flowing into several areas, especially on the consumption side. So I think rural housing and discretionary spend by rural consumers, I think, is going to be a strong opportunity. And therefore, rural housing and therefore associated with that, which means basically cement companies, which means home developers, home appliances companies, building construction and building materials companies, that pack, I think, might do substantially higher. Plus, this pack will also benefit from lower input costs. So to that extent, what we see beyond the next 2-3 quarters is uptick in terms of their volume growth, revenue growth, as well as an uptick in terms of their margins, which essentially will drive earnings growth. So that, I think, seems to be a very, very interesting space that I think we are focused on.
For a classic long-term investor who's got option now to buy HDFC Bank suddenly 30-35% lower than where it was, or an HDFC Limited which is battened down or beaten down, which is one stock you would like to own? If you have to choose between HDFC Bank or HDFC Limited, would you choose both of them, none of them, or one of them?
I think both are outstanding names. Both are frontline names. Both are leaders. Both have had an excellent track record. But what we at this stage at least are saying is that probably there is more value in the individual companies. When I say value, which means that there are better growth prospects. When you own a conglomerate or when you own a kind of a holding company with multiple businesses, then of course at that point of time there will always be something which will set off the strong areas within that. Versus that, we've been owning two pieces of the HDFC group. One is HDFC Bank and the other is HDFC AMC. We've been owning these two names. And we like them for essentially their business leadership and the way they've been able to run their business on a risk-adjusted and capital-efficient manner. So we've essentially been owning both these names within the HDFC pack. HDFC Limited, of course, is also kind of good, but we still don't own it. And let's see, I think maybe going forward someday we may even choose to own that as well. But for now, we own HDFC Bank and HDFC AMC.
Right. Nilesh, hi, morning. You track the IT space as well very closely. And, while the Q1 numbers may be as irrelevant, but what is it that you made of the body language and the kind of commentary that we heard from TCS, the only one to declare its numbers so far? Because it seems that they're more and more confident from what they said last quarter, that they do see a recovery come by in Q3. This time around, they sounded even more confident that the recovery is very well in sight, and that, from the previous quarter itself, the pandemic, outbreak has bottomed out in terms of reflection on their balance sheet. Do you think large IT players can indeed cash in on the COVID opportunity, try and gain market share and increase the pie of their digital revenues going forward?
Yes, clearly the Q1 will have to be looked upon as an aberration. Clearly, obviously, because like everything else, they too have been impacted, and they had guided for basically slippages in revenue side for the first quarter. But right through post-March and even on the current earnings call, they have basically, I think, guided that the coming quarters are going to be stronger. The worst is in a way behind them. Q2 essentially where things will start to normalize, and will gain momentum in both Q3 and Q4 of this financial year. We also have to keep in mind that their customers cannot do without them, because essentially pretty much the services which the Indian IT companies do provide is pretty much non-discretionary in nature. And I clearly believe that the US economy, which of course is going to have a recession in this calendar year, but will of course be able to come out of the woods post 2020. So clearly towards the end of this calendar year, you will see again the US companies being positioned for a recovery and growth. And that's really the time when they will start kind of coming back to their IT budgets for the next calendar year. So I think on the whole, the IT sector looks good. There's of course been a sharp run-up in stock prices recently, so one has to be very cognizant and careful of that. And we also have to keep in mind that the US elections are progressing, the campaigning is progressing. So between now and November, you are going to see a lot of political rhetoric during the campaigning and talks of basically H-1B visa restrictions and all of that. And the administration trying to come hard on immigration and things of that kind. So that will essentially always continue to be some kind of a dampener. So I'd probably think that the strategy for the Indian IT sector should be to basically buy on dips and look for essentially FY22 and beyond. That's what basically I would think. And I think within the overall pack, while yes, of course, the larger companies do look good, but I think there are going to be pockets of strength even in the tier 2 and the mid-cap space.
Sure. Nilesh, how is the entire PSU story to be approached as an investor? Because, while the government's intent has been very clear, the fact of the matter is that you're not going to be able to sell the family silver at the price of gold, given the current circumstances and environment we're in.
Yes, so clearly that entire pack is totally event-driven. It's hard to really kind of look for companies there, which essentially where you can really bet on strong earnings growth. And it's become entirely event-driven, whether it is privatization or disinvestment, or for that matter, them getting orders from the government, especially areas like defense, aerospace. That's the space which is totally dependent on the government. So to that extent, it's becoming very, very difficult to really, in a way, kind of make medium to long-term investments in the PSU track on an aggregate basis. So unless one is really willing to take a call in terms of various events, I think it's best avoided the entire PSU pack. I think it's only when there is a fair degree of certainty. Yes, you might end up buying some of these stocks higher, but it'd probably be better to bet on that pack only when you kind of believe there's a very high degree of certainty in terms of the event playing out. Of course, given that the government has already embarked on the path of privatization and strategic disinvestment, it will happen someday. Though at this stage, it's hard to figure out whether this is going to take 2 more quarters or it's going to take 2 more years. And that's the uncertainty one will have to live with as an investor. So maybe you're probably better off betting on them when you believe that there's a higher degree of the event now actually materializing. That would probably be the right time, rather than trying to kind of preempt in terms of when that is going to happen.
Sure. Nilesh, I know you talked about a 4 to 6 quarter kind of point of view, but we've seen this trend of retail investors getting out of SIPs and looking at the direct markets as an option in terms of returns, given the kind of move that we've been seeing of late. In light of that, where do you see more opportunity, potential returns in the nearer term on the back of the recovery? I mean, would you stick with the preferred place, a slightly safer bets? Would you also think of perhaps looking to add to some extent in the portfolio the slightly more riskier names, or even perhaps names like manufacturing, cyclicals that could see a sharp bounce?
So overall, I really think that it is a very interesting set of opportunities out there. And one will have to essentially construct your own portfolio based on what you basically are the most comfortable with. And I think at this stage, probably one probably needs to kind of have a blend or a mix of things. I would for sure bet on basically growth coming back post 2 to 3 quarters. So to that extent, a lot of businesses which are kind of in a way beaten down versus where they were trading at in terms of valuation multiples a few years back. I think those are a great set of opportunities. Clearly, I think some of the defensives I think are positioned really well. Clearly, that would include areas like pharmaceuticals, consumer staples, I think, and then maybe to some extent utilities. I think that's again a very, very interesting pack from defensiveness point of view. The third essentially is betting on global recovery, and I clearly believe that technology and IT services, I think, will be a great way to kind of play and bet on a global recovery and global growth. And lastly, of course, is essentially consumer discretionary. While at this stage, I'm not too sure entirely whether consumers in urban areas are going to go out there and buy top-end washing machines and things of that kind. But I clearly believe that consumers in smaller cities, towns, villages, essentially with the kind of buoyancy that they're seeing in their part of the economy, are going to be left with consumable surpluses, which I think will find its way into a lot of areas like housing and some of the allied sectors like cement, building materials, as well as some of the very basic consumer appliances and home appliances like kitchenware and things of that kind. So I think these would essentially be a very, very interesting set of opportunities which investors can look forward to and essentially go ahead and build a portfolio accordingly based on your comfort with the individual styles out there.
Nilesh, if my memory serves me right, you're the only fund manager I know who has exposure to PSU stocks, and you've been owning EIL, Engineers India, for what, 3, 4, 5 years now. There seems to be some galvanization in PSU stocks. PHEL has moved from 25 to 44, 45, SAIL from levels of 25 to 34, 35, BEL, 60, 70 rupee BEL is almost at 100 rupees now. I'm sure EIL would have moved in the similar pattern. I've looked at the stock, excuse me. Do you still own EIL? Do you think that there is money to be made in PSUs because they are now in that so-called deep value zone where the margin of safety, I think, is the highest?
Yep. So I think why we like and why we've been liking Engineers India for a while now, essentially, of course, is because there are really no individual set of events out there. I mean, it's not up for sale. It's not likely to be privatized very soon and things of that kind. And it deals with essentially a services sector. It's into the services business. It does not need to do any significant capex for growth, and it has pretty much a kind of a monopoly in the space that it kind of operates in. And so to that extent, I think Engineers India is more a bet in terms of basically their earnings, their cash flows, and their capital efficiency. Of course, post this correction that we've seen in Q1 of this calendar year, we've seen the valuations also come off and become very, very attractive. So I still think that we continue to own Engineers India. We continue to like it. We continue to be buyers in Engineers India. And I think at this stage, I think the business is still rock solid. They had a great March quarter, and their outlook for the next 1 or 2 years is very strong. And so to that extent, I think we continue to like it. And especially at these kind of valuations, it probably comes across as one of the most attractive bets, not just in the PSU pack, but overall without any event or something to really bet on. So yes, I think it still looks attractive for us.
Nilesh, what's your view on SBI cards? Because I'm yet to meet a classic value investor who says, look, I like the stock, I want to own the stock. If all of us are morphing towards more digital usage, SBI cards is one of those businesses where the ROAS is north of 30%. They don't need capital. The balance sheet does not need capital to grow. What's your view on a typical proxy on Indian consumer? Because if we'll consume more, we will consume less currency. I mean, we will be now transacting less via currency notes and more on a credit card or on a digital platform.
Yep. So that's a very interesting opportunity, and but I think what has really changed over the last few months is that I think prior to basically the March sell-off or prior to basically the Q1 sell-off, most private banks were essentially also trading at relatively higher valuations versus where they are trading right now. And so to that extent, maybe at that point of time, a standalone company like SBI Cards, I think made a lot of sense. But we have to keep in mind that SBI Cards is dealing with unsecured business. Their loans which they give out are not secured, and therefore one has to keep in mind that some of these unsecured spaces essentially are not as safe as you might think, and obviously pose a very different kind of risk. So my sense is that I think at this stage, and given the kind of challenges which the banking and the credit plays are going to witness over the next few quarters in terms of their asset quality, I think that it still makes sense to basically be with a more universal kind of a bank, which is very well run. The portfolio is time tested, and all of that. So I probably still believe at this stage yet that I would probably prefer a very comprehensive, well-managed private bank versus a standalone credit card company or any other things. Maybe if a few months, few quarters down the line, if things get better, things get normalized, and we see the portfolio of the credit cards business essentially in a way gone through some kind of aging, then maybe it's better to probably take a call then. But for now, I still think that the well-run private banks, I think, are a better play versus some of these standalone NBFCs or credit card loan companies.
Always a pleasure to have you on ET Now. Thank you for joining us. Look forward to more engagements going forward. Stay safe and hope to see more of you.
Thank you so much. Thanks.